Hello and welcome to my channel all about accountancy, where we convert your accounting problems into solutions. I am your host Professor Tanmaypvttutor and welcome to my series Concepts and Conventions. This is the 8th video of this series. If you wish to check the entire series, I will link it down in the description box and at the end as well. The concept that we are going to cover today is the accrual concept. According to this concept, an accountant is supposed to record all the business transactions on accrual basis. Before moving any further to this concept, let me inform you that there are two methods of recording business transactions. First is the accrual method and second is the cash method. To understand both these methods properly, let us take an example. Let us assume that a trader purchases goods worth Rs 5,000 on 1st January but makes the payment on 10th January. So you can record this transaction either on 1st January or on 10th January. If you decide to record the transaction on 1st January, that is on the day of actual purchase, then that method is called the accrual method. However, if you decide to record the transaction on 10th January, that is on the date of payment, then that method of recording is called cash method. Both these methods can be adopted, but as per the accrual concept, you are supposed to record the transaction on the day it occurs rather than when the payment was made. Hence, the accrual concept suggests the accountant to record all that business transactions as and when they occur, irrespective of whether their payment was made or not. Sometimes there are expenses which are paid before the due date. Such expenses are called prepaid expenses and such incomes are called pre-received incomes. These incomes or expenses are not actually due, but the payment has been made in advance. But if the accountant is recording these pre-received incomes and prepaid expenses in your current income and expenditure, then that approach is wrong because the accountant is following the cash approach. Your accountant is recording these transactions just because the cash has been paid or received for it. But as per the accrual concept, you are supposed to record the transaction when it actually becomes due. The cash paid or not is not important, but the due date of the transaction is very important. For example, when we are paying the prepaid mobile bills, we pay the money first and then we use the mobile facilities. So when you pay the money, you are just converting your cash into your mobile balance. Until unless you do not use it, it is not called an expense. For example, I am recharging my mobile in the month of February, but I would be using the money in the month of March. So this expense is to be actually recorded in the month of March and not in the month of February because it belongs to the month of March. Just because you have made the payment in February does not mean that you are supposed to record it in the month of February. Record the transactions only when they are actually due. So if your accountant has included such income or expenditure in your current income or expenditure, you are supposed to subtract them. Similarly, there are many expenses which are paid after the due date. For example, electricity bill, landline telephone bills, postpaid mobile bills, etc. You use the services first and then you are paying the money to the company. These expenses are called outstanding expenses. In such cases, if the accountant has not recorded your expense, then that approach is wrong. Your accountant should record these expenses because they actually belong to this period. Just because the money has not been paid, it does not mean that the expense does not exist. Outstanding expenses are to be added if the accountant has not yet recorded them in the current transactions. In short, the accrual concept is telling you to not pay any attention to the cash but pay attention to the occurrence of the transaction. Record the transaction only when it actually occurs. Just because the cash has been paid, that does not mean that the transaction has been made. Hence, we end up recording all the income and expenditure of the current period only. Hence, if we want to calculate the profit for 1 month, we can easily subtract the expenses of that month from the income of that month. Therefore, this concept is also known as the matching concept because in order to calculate the profit, we are going to match the expense of that month with the income of that month. Hope you have understood this video. If you have, then please like it, share it, subscribe to my channel and hit the notification bell as well. If you have any suggestions or queries, you can post them in the comment box down below. I upload videos every Wednesday and Sunday. See you in my next video. Till then, this is Professor Tanmay Kesarkar signing off. Good luck and take care.